You won $100 million. For 10 beautiful seconds, every problem you have ever had disappears. No more rent, no more boss, no more checking your bank account before ordering appetizers. Then your phone rings. Your cousin needs help with a business idea. Your old roommate has discovered an emergency. A financial genius you have never met would like to protect your future. And the government has already pulled up a chair. The ticket made you a winner. It also made you valuable. And valuable things attract people who want a piece. So let's follow your $100 million jackpot from the moment you win to the moment the money is actually protected. Because winning takes 10 seconds. Surviving the win is the full-time job. Part 1. Do not claim it yet. Your first instinct is completely reasonable. Run to the lottery office. Collect the giant check. Quit your job through a window. Do none of that. Right now, you have a piece of paper surrounded by deadlines, claim rules, and several spectacular ways to make your life harder. You secure the ticket. You verify it through the official lottery. Then you check the rules where it was purchased. Lottery privacy is not one national rule. Some jurisdictions let winners remain anonymous. Some allow a trust or another legal entity to claim. Others can release your name, hometown, prize amount, and where the ticket was sold. Depending on where you bought it, claiming could announce that your bank account has become a public attraction. And before you claim anything, you face the first giant decision. Annuity or cash? The advertised jackpot is generally the annuity value. In a Powerball-style jackpot, that means one payment now, followed by 29 rising annual payments. The cash option is the smaller pile available today. For our example, imagine the screen says $100 million, while the official cash option is $45 million. That is illustrative. Real cash values change with the game and drawing. But your first money counter still drops from $100 million to $45 million before you buy a single thing. Congratulations, you have lost $55 million imaginary dollars. Part 2. The government gets the first real piece. You choose the $45 million cash option. Now, federal withholding enters the room. Qualifying lottery winnings are generally withheld at 24%. 24% of $45 million is $10.8 million. Your $45 million becomes roughly $34.2 million on the first pass. And the phrase first pass is doing dangerous work there. Withholding is only a payment toward the final bill. Under current federal brackets, most of a jackpot-sized award lands in the 37% marginal bracket. That does not mean every dollar is taxed at 37%. Tax brackets work in layers. But it does mean the automatic 24% withholding may leave several million dollars still reserved for federal taxes. Then your jurisdiction may add state or local tax, or it may not. The result depends on where the ticket was purchased, your filing situation, and the rules in effect. So our winner does something painfully uncinematic. They create a tax reserve and refuse to spend it. The money is visible, technically theirs, and touching it would be like eating the cake someone brought to your audit. Part 3. Everyone suddenly remembers you. Your phone used to contain 12 people who actually called you. Now it looks like customer support for the entire family tree. Some requests are real. A parent needs medical care, a sibling has debt, or a friend stood beside you when you had nothing. Helping them is not automatically foolish. The problem is that money turns every request into a test of love. If you say yes, the next request grows. If you say no, you have changed. If you ask for paperwork, apparently you have become corporate. Then come the business ideas. A restaurant with no menu, an app with no customers. A revolutionary investment whose main innovation is that nobody can explain it. And gifts are not always as simple as transferring money and returning to the party. Federal gift rules can create reporting requirements beyond the annual exclusion, even when no immediate gift tax is due because of larger lifetime rules. That is a tax professional conversation, not something you solve because your uncle watched half a podcast. So the winner builds a process. There is a fixed generosity pool. Requests receive the same review. Nobody gets an instant answer while crying beside a new car dealership. The process feels cold. That is the point. It prevents every relationship from becoming a live negotiation with your guilt. Part 4. The helpers arrive. Sudden wealth creates problems that require professionals. It also creates professionals who require sudden wealth. You may need a lawyer, a tax professional, and an investment professional. Those are different jobs. One person having a confident handshake does not make them qualified to perform all three. So you verify registration and disciplinary history, ask about fees and conflicts, and read the agreement before handing anyone access. Because every advisor gets paid somehow. An hourly fee, a flat fee, a commission, a percentage of your assets, a product that somehow becomes more attractive when it pays them more. Small percentages stop looking small when the account has 8 digits. 1% of $30 million is $300,000 every year. That does not make the service bad. It makes, "What exactly are you doing?" a $300,000 question. Then come the obvious scammers. Urgent calls, fake fees, secret opportunities, people asking for account information so they can release money you supposedly already own. If someone contacts you about a prize and says you must pay them to receive it, stop. Real prizes do not need gift cards. Your team should make the money harder to move, not easier for one impressive stranger to control. Part 5. The most expensive person is you. The taxes are reserved. The family process exists. The advisors have been checked. Excellent. Now you can finally destroy the money personally. People love repeating that most lottery winners go broke. You have probably heard a specific number? Usually 70%. Do not use it. That statistic is not supported the way the internet claims, and serious research does not show that winning automatically ruins your life. In one long-run study of large Swedish lottery winners, life satisfaction remained higher even years later. Money can make life better. The danger is pretending a finite windfall creates infinite income. You buy a mansion. The mansion brings property costs, insurance, maintenance, furniture, security, and a swimming pool that has somehow developed its own payroll department. You buy the cars, then storage, insurance, repairs, and more cars that make the first ones look financially responsible. One ridiculous purchase probably does not kill a $30 million fortune. A permanent lifestyle built around them can. The expensive part is not buying something once. It is creating a new version of yourself that must keep paying for it forever. Part 6. Build the fortress without becoming the prisoner. At this point, protecting the money can become its own obsession. Every friend looks suspicious. Every unknown number feels like an attack. You can save every dollar and still let the jackpot take your life apart. So the final system protects more than the account. The winner divides the money into lanes, taxes that cannot be touched, long-term capital that supports the future, a planned generosity pool, a lifestyle budget large enough to enjoy the win without pretending the money regenerates overnight, and a small group of verified professionals whose powers are separated, visible, and reviewable. Major decisions wait. Requests follow a process. The winner keeps a purpose beyond spending and defending money. Then we return to the ticket. It still looks exactly the same. One tiny piece of paper. But now you understand what was hiding inside it. Taxes, publicity, expectations, conflicts, temptation, freedom. The lottery made you rich in 10 seconds. Everything after that decides whether it also makes you free.